consumption, and therefore a reduction in the pricing power of firms, which would show up in a more deceleration in inflation rate. So at that point, I did vote for a 50 basis point cut because I thought that financial conditions at that time were not consistent with what I saw as the prospects for the conjuncture. Moving to May is where I chose to hold bank rate at the rate that it was. Now, what it changed from February to May was the labor market had not loosened as much as I expected. Consumption does remain weak, but no weaker than it was that I had thought. And then importantly, inflation, although decelerating, was not decelerating consistent with achieving the target of 2% in the medium term. Particularly, for example, goods prices were rising, not falling. Services prices continuing to remain well above anything consistent with the 2% objective. But most importantly, from February to May, financial markets had eased quite dramatically by even more than the 50 basis points that I had voted for in February. So it's that combination of conjuncture, activity, inflation, but importantly, the state of financial markets that contributed to the two votes that I think need to be seen together in context.
Thank you. And of course, the Governor and Ms. Breedon were somewhere in the middle. So do you want to explain what your thinking was in voting for the change, the cut that you voted for? Governor.
Oh, thank you. First of all, I would say that although obviously the news has been dominated by the events coming out of the US, and no doubt we'll come on to this later, I'm sure, in my judgment, the key factors in our decision, in my decision certainly, were actually still starting with the domestic UK situation and the UK drivers, and then I sort of played the news coming out of the US and the world economy into that. And in light of that, and just picking up what Katherine's just been saying, because it's quite a good starting point, I mean, the key thing for me is, are we on course for inflation to come back to the 2% target? Are we on course for this sort of, unwinding of any persistence elements from what we saw a few years ago? And the key judgment there, for me, is really on the labour market. And I do take a slightly different view from Katherine on this. I actually don't think we've seen particular surprises in the inflation outturns relative to what we were expecting. The labour market actually, for me, has loosened somewhat. I mean, it's interesting with the numbers for pay. They're obviously at a level currently in the official data which is above anything consistent with the target. They're also actually out of line with past relationships. On the other hand, actually, we're actually under the path we were expecting in the February report. But more particularly, I think the key question for me is we've got this, we've got a view which is that we will see pay coming down this year. It was a central point in the survey that our agents did at the start of the year. And at the moment, I would say I think that path is intact. Partly on partly my judgment is based on what we're seeing in the more sort of immediate data that we're seeing, but it's actually substantially also based on a lot of trips around the country, talking to firms. And my judgment is that we are seeing that. I mean, that's what firms are telling me they're seeing. But that's going to be a crucial judgment going forwards, which is why, gradual and careful remain my sort of guiding line, as it were.
Okay, thank you. Ms. Breedon.
Thanks, Chair. Like Andrew, I was focused on domestic developments as I approached this decision with the international environment and overlay on that. And indeed, I'd thought that there was a case for a cut in bank rate even absent the international developments, because I judged that domestic disinflationary process that we've all talked about was progressing as I expected, and I thought it would continue. I had two factors in mind when I approached this decision: persistence and spare capacity. On persistence, I judged the outlook for that to be very dependent upon what was happening to wages, and I had no evidence to doubt the steer from our agents' pay survey that come the end of this year, the policy relevant horizon, wage settlement should be around 3.7, 3.8%, which is a good percentage point below where we are now. The DMP had the same data. On spare capacity, it's hard to observe that, but I judged that some was opening up, and my focus was on the labour market. Employment growth is flat. Population growth is 0.25 percentage point. Vacancies are falling, and there's evidence of employees wanting to work more hours, all of which suggested to me that there was some spare capacity opening up, the labour market was loosening, and that it would continue to do so as we looked ahead. So given monetary policy was restricted, given I had no evidence to suggest that persistence would be higher than we expected, and with loosening in the labour market, I was happy to cut bank rate and then played the international risks into that.
Okay, well, thank you. I want to go back to you, if I could, Dr. Dhingra. You have been outvoted, as you answered this in your questionnaire, 16 out of the 21 MPC meetings that you've attended. So you're an outlier. So we quite like talking to people who've got different views on this. And you highlighted in your questionnaire that you think that we could have contained inflationary pressures with a lower peak in rates. So others, when we've had other members of the MPC in front of us and the governor, they'll talk about a slow glide path to 2%. You wanted to see a lower peak in rates and then a faster change. Do you want to explain that a little bit more?
So I would say I wanted to see a lower peak and held for longer till as long as was necessary, and also to reduce the risk of then falling too low where we don't have enough policy room and have to rely on unconventional policy tools. That would have been my preferred path, but of course that's not where we ended up. So I've had to adjust my vote according to the paths that actually prevailed, as opposed to what would have been my optimal, desirable path to follow. That being said, I can give a little bit more perspective on why my view might be different from the others, and why sort of, ex ante, you might think that both things make sense from a point of view of policy setting. So the consensus view was typically sort of coming out of the pandemic that there was strained capacity, there was demand which was fueling inflation, put on top of that supply shocks, and you end up in a situation where you get very high inflation. And of course, it's perfectly reasonable at that point to think that the process of disinflation would be asymmetric. It would, inflation would rise much faster, and then when on the way down, it would slow down. Businesses would want to start building margins, and we would expect to see real wage growth rise and then consumption also pick up, all of which would then mean a lot more inflation persistence. I didn't think that that was really going to be the case at that point, largely because I was relying a lot more on data that looked at supply chains and granular price information as to how prices passed along the supply chain, and you were already starting to see evidence by the time I was put on the committee that some of these supply chain pressures were starting to ease. There was also sort of a lot of noise in the wage data, which I was very early sort of getting very concerned about. And putting those various factors together, my general view was that I didn't think that the disinflation process was really not going to happen, that it was going to be intact, and I'm glad that that's actually borne out in the data.
Okay, so now do you agree with this slow glide path towards 2%, even though, or do you prefer, yes, do you agree with that slow glide path? Is that where you think we're going?
I think so. I think keeping policy gradual is a good thing. The problem now, from my point of view, is that if I think that for a long time we've held policy too tight, at some point that level and that time period over which policy has been tight starts to really play a role, which means I now need to start thinking about, do I increase the decrements for which I've been voting or not? And I think that's really been the key challenge that I've had to face.
Okay, because you've got your next meeting, of course, 29th of June, so well, maybe I'll come to that in a
The
moment.
week before, actually.
Sorry, 20...
No, week before that.
Week before, 26th of June, is it? Sorry, forgive me. Dr. Mann, what about you and the gradual glide path? Because you've really, as you explained, moved very sharply from February to May already, in your opinion.
So I do believe that we're going to get to 2% at some point in time, but I do think there are two factors that are relevant in my voting strategy. The most recent switch from 50 basis points to hold is importantly affected by the volatility in financial markets that is coming through spillovers from what's going on in other economies. Both the macroeconomic developments as well as policy developments in other economies. And because that volatility is so great and has been great since, the last couple of years, in order to make a clear statement about the stance of monetary policy appropriate for the UK, I think it's important to make a bolder move and then to hold for longer. Now, if you look at my voting record on the way up, as in when inflation was rising, I was voting for larger increments to be front loaded in order to keep inflation more at bay. That was not what the committee as a whole chose to do. But my votes on the way down, so to speak, as inflation has come down, is following the same strategy, which is that in order to make a clear statement to the financial markets and also to economic players, for example, the pricing strategies of firms or household expectations, because these are affected immediately by voting behavior, voting outcomes, that it's important to be very clear about what the stance of monetary policy should be for the UK. And that's why I follow this so-called activist strategy, which is to make the moves larger, so to cut through the noise that's created by volatility in the financial markets that is coming from spillovers from other large economies that we are surrounded by.
Thank you, Dr. Mann. Bobby Dean, MP.
Thank you. I'd like to come in about the voting patterns. I mean, it's notable to me that the bank staff have one view and the external members have another. One is about sort of going more boldly, more quickly, and then holding for longer, and the other is a much more sort of softly, more gradual approach. So maybe a question to you, Governor. Do you feel that there is that divide in the committee? I'll just add as well that this time I think 4 out of 5 bank staff voted the same way, and the 2 members we have in front of us today I think have always voted the same way. So can you give us any views on that, whether you think that there's a sort of culture of voting amongst the bank staff?
I would say this, that I think, let's take the case of Huw Pill, who voted with Katherine. I think Huw has set out a very clear view. He doesn't, he takes a different view.
He is the exception this time, yeah.
Well, we've had other. I mean, Dave Ramsden has voted different ways, certainly to me, over time. So John Cunliffe did when he was on the committee. So no, I mean, it's not the case. I think you've also heard if you don't mind me saying so, 2 very different views from the external members of the committee this morning, and that's that's fine. I've always said in the past, because we've had these discussions before about so-called groupthink on the committee, that I really don't think there is groupthink on the committee. Now, the evidence of that in some ways, of course, is the votes, or it is the votes actually, and do think that what we saw in the last meeting, I think, does demonstrate that.
Okay, but I mean, just to maybe Sarah Breedon, you'd like to come in as well. I know that you voted the same way as the majority and as the governor every time. What's your view on the bank staff kind of tending to cluster together? I know there are exceptions that the governor's just mentioned, but it does seem to be a pattern.
So look, despite having voted with the majority on each occasion that I've voted on the MPC so far, my interpretation of the economy and what's driving inflation has at times differed. So you should think of the majority as having a broad church within it. And what we try and do in our communications is convey what that broad church includes, so that as data come out through time, the markets and people like yourselves can understand where we're likely to go. I mentioned at the start, when I described my vote on this occasion, that had the international developments not occurred, I would probably have voted to cut rates anyway. As the minutes of our meeting made clear, that was not the case for all of them. So I guess I'd underline, think of the majority as a broad church, and our communications being as important as the vote in signalling where it is that policy is headed.
That's an interesting point. If I could just add, from my perspective, I probably wasn't really quite in that position going in, as it were, before the international stuff. I was frankly much more undecided and waiting to see how the UK position evolves. So there are differences of views between us in that.
Yeah, I appreciate there'll be the differences of views, but the outcomes, I guess, are important, and whether or not you go for a bolder 0.5 move at any point, as others on the panel today have suggested, is quite significant. I mean, Dr. Dhingra, I don't know if you want to come in and give your perspective on this potential. Do you notice any differences between the external and bank members of the group?
I can talk about my position as to why I was moved towards a 50 basis points cut as opposed to what would have been the majority of a 25 basis points cut.
I think we've heard your view, but kind of whether or not you feel that there's a divide or not, your view on that?
I don't see that, and I take my job very seriously. I'm an external member. I have to look at the research and the evidence and vote according to what I think is right, and I'm better at doing that job than figuring out what the dynamics of any committee are.
Okay. Good. Yeah, I guess
we're politicians. And Mr. Dean.
And I just give Mrs. Mann a chance to come in as well. Dr. Mann. Dr. Mann, your view as well, if you feel there's any differences between the bank staff. Sorry, the delay.
Sorry about that. So my view is that each person on the committee takes their job very, very seriously and evaluates the research and comes to conclusions. And I think what you're hearing from this very short introduction really is the extent to which people interpret the data differently. They interpret the collection of, say, activity, inflation, and financial markets. They weight those things differently. I think we'll probably be talking about scenarios later. These are different ways of presenting possible outcomes that don't cover everything that we've been thinking about or talking about, but are a selected set of possible ways in which shocks could be different, or economic relationships could have changed over time. And so, those explorations through scenarios are a reflection of the kind of differences in what we bring to the analysis and to our decisions. So, I don't think it's the committee isn't sort of us and them type of thing. It's very much different people approaching the data, economic relationships, weighting of these different variables in different ways.
Thank you, Chair. And we've obviously got a lot of detail, particularly from Dr. Dhingra this time round in answers in her questionnaire. And before I move on to Mr. Grady, Governor, we've seen a repeated set of reductions in the interest rate, that glide path that you've talked about before in front of this committee. Are you confident that that's going to be the way forward when coming up to your June meeting?
Well, I'm not going to make any prediction on the outcome of the June meeting.
It's just worth a try.
Interesting. Good try. Good try. One of the things I sort of spent a lot of time just with when I faced the journalists is spotting those questions which keep coming up.
Pretty blatant, that one.
Multiple. They're more blatant. Yeah. Yours is much more subtle. So prize for that. Look, I think it's a fair question though. In terms of the path, I think that the path remains downwards, but how far and how quickly is now shrouded in a lot more uncertainty, frankly, and I'm sure we'll come on to the external situation, but it is, of course, relevant there. We've added the word unpredictable to uncertain because of the sheer nature of what we're dealing with. So,
Dr. Mann, I hope you heard that answer clearly. What's your view about the general direction of travel, the glide path?
No, I would agree with the view that the glide path is downward. I do. We'll have to see what the what kind of briefings we will get for the next vote, and how some of the data develop in terms of, particularly my concern is on inflationary pressures. Um, uh, and so I can say that the direction is down, but in what sort of steps and
Okay.
what time frame, I think we still don't know about that. We have a lot more to be looking at in terms of the outcome of policies that haven't yet been fully developed
Okay,
in
thank
other
you.
economies, and the spillovers from those will be important for decision making.
Thank you. Sarah Breedon, briefly.
Thanks, Chair. The big picture narrative of policy loosening as the waves of disinflation continue, I agree with. But as others have said, there is uncertainty about how far, how fast.
You still think we're going in the
Absolutely.
downward direction? And Dr. Dhingra, you agree? Okay, thank you. John Grady, MP.
Thank you, Dame Meg. Governor, since we last spoke of this committee, the global trading system has become somewhat unpredictable, from Liberation Day to arguments this weekend about the exports of critical minerals and rare earths from China. There are real concerns about President Trump's big, beautiful bill and warnings that the US bond market could crack, with the Treasury Secretary in the US reassuring investors, it seems, that the US won't default on its debt. So where does this lead the global trading system and the global economy more widely?
It leaves us with, of course, a lot more uncertainty and unpredictability about it. I mean, just to illustrate that, there are really, I sort of boil this down into two judgments that we have to make. I mean, what are the policies going to be, and what's the impact of those policies? And obviously, on the first one, what are the policies going to be? I mean, the challenge we have to do is that whenever we take our decisions, we have to stop the music at some point and say, well, where are we? And that was very difficult. And of course, indeed, if you now, three weeks or so since we took that decision, as you were just saying, the world, we've had a lot more has come out in that period, frankly going both ways in terms of where this may be. And as Katherine was saying, this is having a big impact on markets. Markets have moved quite a bit since we had this had our last meeting. I think it's more, in some ways, more important to focus on the second point, which is what's the impact of all of this. And I think at the moment my judgment would be as follows. I think the impact of fragmenting the world trading system is negative for world growth and world activity. I think it obviously increases uncertainty, and this is very well established in sort of economics, but you hear it now when you go around the country from businesses. One impact of that is that it tends to cause delays and putting off of investment decisions, because an investment decision is typically is a once only irreversible decision. And so if you're offered the chance in that context to say, should I take it now or should I wait, the appeal of waiting goes up, frankly. As we've, I think, said before, I mean, the impact on prices is much more ambiguous, actually, and this is the real area for me of question. I think the first interpretations are really that it's lower activity, lower world activity, which will lower world export prices, which will lower inflation. That's quite open to question, though. I was interested this morning, the OECD have come out with their new projections, and they've actually somewhat gone the other way and said, yes, it's lower for activity, but it's not necessarily lower for inflation. And the reason for that is, and we tried to bring this out in our scenarios, is that if it affects the supply side of the world economy, so if it starts disrupting supply chains, for instance, that could have the opposite effect, that it could actually, could start disrupting markets, supply chains and markets again, and that could actually put some upward force into pressure into inflation. Now, at the moment, it's really, frankly, too soon to tell. We're not seeing the sort of effects on supply chains that we were seeing sort of back in 2021, for instance. But it is a genuine concern because, I think the best example of this is the US-China. I mean, I think US-China is the centre of this whole thing, really. And the question of where that's going and what effect that's having on supply is obviously a very important question. So we're going to have to keep watching this very carefully, I'm afraid.
Well, question. I mean, we've heard various diverse views about how monetary policy should move forward. Does all this uncertainty lead to a serious risk that despite the bank's best endeavours, monetary policy could go badly wrong with inflation undershooting or overshooting the target?
Well, let me say two things on that. Start with more of the sort of the theory part and then come on to the sort of practice. There's a huge amount of debate, obviously, about how you respond to uncertainty. I mean, one school of thought is that it causes you to react more cautiously. And that's because you sort of, in a sense, you want to wait to see how it develops. That's not an unreasonable view, and one that I certainly, put some weight on. But it is not a reasonable view if you think that there is a threat to the integrity of the anchor, which is the inflation target, clearly. In that case, the answer, I think, is that you should act more aggressively, Katherine might use the word activistly, I don't know, as an activist. Now, I'm not seeing that at the moment, but I think it's important. That's an important thing that we have to sort of keep in our mind as we make these judgments, that it isn't always the case that you respond to uncertainty by being more cautious. Now, that's the first part. In terms of the second part, how you sort of play that out into the decisions, and you made the point, could you go badly wrong? And that was a very big question for me in this decision we took 3 weeks ago. And this is really where the scenarios came in, because we painted two scenarios. One was, frankly, weaker demand, could be domestic, could be international. The other was the supply side, could be domestic, could be international. And the question for me was, these scenarios helped me to answer the question which your question really goes to, which is how badly wrong could you be as a guide? And I think the point I took from the scenarios was, you could be wrong, but you're not going to be so badly wrong that you're losing control at that point. And that gave me greater confidence to use what I might call the more careful and gradualist, continue to use the more careful and gradualist approach and do the 25.
And Dr. Mann, how about you? Are you confident that things won't go badly wrong faced with all this unpredictability?
I would agree that we have a tremendous amount of research background coming from the staff to give us information about alternative outcomes under alternative assumptions about the relationships among economic variables and the prospects for global demand or inflation. The one point where I would differ a little bit with what the governor has painted is on the sort of the inflation dynamics and how uncertainty about inflation dynamics, what do we know about that from research? What we know from the research by bank staff is that in an environment of higher volatility in inflation, something we may well observe as supply chain costs change or global export prices change or whatever variability. So under that environment where you have inflation volatility combined with the nature of labor and product markets in the UK, which is that there is downward bias to price settings and to wage settings. In that environment, you end up with upward bias on inflation, prospects for inflation going forward. And the proper response under that kind of scenario is for a more aggressive, activist, bold move to ensure that the anchor, the 2% objective, doesn't drift. I wrote a number of speeches about this topic during the high inflation period of a couple of years ago. I think that is still something we have to be concerned about because inflation, of course, has come in as expected, but nevertheless high. And it approaches a threshold, which in the research, a 4% inflation is a threshold that may change consumer behavior and attitudes towards an inflation process, which then could feed back to wages. So it's important to kind of think about these asymmetries in both the inflation dynamics and in wage and price settings as we consider appropriate monetary policy decisions.
And then last questions that really, all this is all very interesting, but what my constituents want to know is when they go to the shops, that prices aren't going to get out of control again. How confident are you, Dr. Dhingra, against this background, that we can reassure my constituents that when they go to the shops in Glasgow, prices over the next 2, 3, 4 years will remain within a tolerable band and not be subject to excessive inflation?
I'm somewhat encouraged by the developments that have happened globally, that they are going to stay within control, for the reason that the really worst case extreme scenarios would be where you see a real meltdown in supply chains, which is to say that the EU starts following policies similar to the ones that the US is implementing, so does China, and we see the world fragmenting into these very multipolar places, and then everybody wants to go chase the same suppliers and get all their supplies from there. I don't think we're headed in that direction. If anything, the way the global policy developments are going, of course, this is all contingent on me commenting about something which is highly unpredictable. But given the way things have panned out, I'm actually a little bit more reassured that it's going to be milder than some of these, not even the worst case scenarios, but even some of the bad case scenarios. So I'm somewhat reassured by that. The only other threat that you can see at the moment would be that we're having this uptick in inflation, and maybe that translates into something more permanent, something more persistent. And again, there I'm somewhat reassured by the fact that you don't see the same kinds of inflation expectations uptick that you see in household expectations show up in firms. So that's somewhat encouraging. It's also something which looks more like a one-off change rather than something which has momentum on its own. So again, I'm not terribly worried about that. And I think the context really helps in that case, that we've had a period where there has been consumption weakness, where the labor market has loosened. We've had interest rates much more restrictive now. So we're not in that situation which we found ourselves in 2022 when the really large energy supply shock happened. So in that sense, I think you can probably go to your constituents and be a lot more reassuring than what you could do, say, in 2022.
And Mrs. Breedon, if we were having a tour around the shops at Parkhead Cross in my seat, would you be in a similar boat of reassuring my constituents that prices will remain stable over the next 3-4 years?
I would underline that last point that Dr. Dhingra made just then. What's important is the context in which the current inflationary dynamics are occurring, and with restrictive monetary policy and with a looser labour market, the conditions for inflationary dynamics getting out of control are very considerably less. I would reassure your constituents.
Thank you.
I should say I will be in Glasgow tomorrow and Thursday, so I'll try to do this.
Recommend the shops in
We have a committee
Cross.
visit. We have a committee visit there very
you,
soon.
Meg. I think that's enough from
Mr.
me.
Grady's been speaking up for his constituencies so much we all need to visit now. And Dr. Dhingra, thank you, because you've gone into a lot of that in detail in your questionnaire, which was very interesting reading. So that is obviously now published as well for anyone who's following today. Chris Coughlin, MP.
Thank you, Chair. Governor, we've seen a dramatic recovery in equity markets in recent weeks since the heavy sell-off since Liberation Day. So to what extent do you support the hypothesis of the taco trade, that the damage that President Trump does to the world economy is overstated because Trump always chickens out and he's terrified of the bond markets?
Well, I'm not really going to get into the question of the taco thing. I think that's a euphemism that people in markets have come up with. I don't think the president particularly likes it. I think obviously you have seen a lot of volatility. Equity markets is part of that story, but it's not the whole story. I think the points when I think what I would be most concerned is when we see the sort of constellation of rising government bond yields, falling currency and falling equity markets. Now, we had two periods sort of in the post-Liberation Day period where that became quite acute, frankly, and on both occasions I think the administration did respond. The first one led to the 90-day sort of period to negotiate trade agreements. The second one concerned the position of Chair Powell. We haven't seen that particular constellation since, because, as you rightly say, the equity markets haven't behaved in the same way. But I think we have to watch this very carefully, because the equity markets clearly are obviously discounting, views of the future. So they appear to be discounting a more optimistic view of how this will come out. Well, I think what we need to bear in mind is therefore that their view of it is conditioned on that, and if obviously things change, then they will respond. What we haven't seen, however, fortunately, is I think a real sort of really serious threat to financial stability coming out of this. If you look at the whole period now, because it's not over, but that would be my assessment.
Exactly, and quite to your point, obviously we've seen an increase in US bond yields.
Yes.
Rise in US tariffs, yet a fall in the dollar.
Yes.
Which you would not expect. And so, I mean, do you think there's a chance of that being a long-term threat to the dollar's safe haven status? And potentially profound?
Yeah, okay, let me take that in two parts. I think it does indicate that non-US investors are obviously, reassessing their view of the amount of US risk they want to take. I think, by the way, a context to put that in, because people in the market say this quite often to us, is that quite a few of those, they were probably overweight US risk going back in time, because they had a very optimistic view of the US economy, not unreasonably actually, and they're probably they're reassessing that, and they will do that. I mean, they will go on doing that, I'm sure, as this sort of story unfolds. Now, I've deliberately separated that off from the reserve currency point. Obviously, there's a link here in terms of how much of a particular currency risk do investors choose to have. But I distinguish this because I think reserve currency carries with it a lot more. It carries a lot more, if you like, sort of embedded presence in world markets. It carries a lot more infrastructure with it. And the dollar has had that position, obviously, ever since it took it over from us, actually, really. And that's also increasingly embedded in markets. So if you think about the role that US Treasuries perform as the safe asset in markets, and therefore as collateral and security, it would take a lot to change that. And also, frankly, I don't think any of us should want to see that happen, because that would be quite a destabilizing moment. I don't see that happening at the moment. I think we have to watch it again, but I don't see that happening at the moment. But that's a much bigger effect than markets repositioning themselves in how much particular risk they take.
Ms. Breedon,
I wanted to add just one point on the dollar that reflects a lot of the market intelligence that we've been getting. Andrew talked about, the governor talked about how that we'd seen some changing of positions in US assets. The interesting story about the US dollar is that some of that is about foreign holdings of those US assets not being previously hedged and now being hedged. So you get a movement just in the currency and less so in the underlying asset prices. That matters for us as monetary policy makers, because what happens to the exchange rate is an important input into the inflation outlook. But it also matters from a financial stability perspective as to who's bearing losses and how might they come back. That hasn't been an issue for UK financial stability.
And if I heard correctly from the governor, there hasn't been a threat to UK financial stability from you'd agree with that. And how about the increase in long-term US debt yields that we're seeing? That, I mean, obviously both as a result of President Trump, but also potentially the tax cuts coming through. I mean, how concerned are you about that and the flow through to the UK?
Why don't I take that one, Mr. Cotland? We've seen a trend globally of long-term interest rates rising. So it's a story in the US, it's a story in the UK, it's a story in Europe and Japan. It's not really been a UK-specific story. The good news is that markets have functioned through all of that. It doesn't much matter from a monetary policy perspective. The rates that matter for businesses and households are at the shorter end. But from a financial stability perspective, we have seen markets function through that period.
Is there anything you want to add, Governor?
No, I would agree with that. I mean, just emphasise the point that some of the biggest, I think the biggest rises in long-term yields have been in Japan. So we do have to watch outside the US as well.
Yeah. Thank you very much. Rachel Blake, MP.
Thank you, Chair. Governor, you've talked about the importance of trade deals, and I wanted to ask how you assess the significance in terms of growth and inflation of the recent UK-EU trade deal.
Well, I'm a strong supporter of open markets and free trade. And I made some remarks on this actually last week in Dublin. Let me draw a sort of distinction between the short term and the long term. I think in the short, one might put the sort of the US-UK agreement into the shorter term in the sense it's addressing obviously the particular issue of the moment. I've said before, I think in the circumstances, and I use those words advisedly, I think it's a good thing. But the reason I use the words in the circumstances are two parts to it. One is that it still leaves obviously the average tariff level higher than it was pre all of this starting. That's important to bear in mind. The second thing is, and this is where I get to the other agreements as a sort of bridge to that, the UK is a very open economy, always has been for ever since we industrialised. So what affects our economy is not just whatever trade agreements we do, but also what the rest of the world does. And it's sort of like, you go back to this point about China, but you could make the same point about the EU, that whatever they do will also have an effect on us as well. Now, on the other, you raised rightly the point about what's been agreed with the EU and the India trade deal. I see these in a slightly longer context. Go back to Brexit for a moment. We've always sometimes been slightly controversial for saying this. I said it again last week. Then I'll just reiterate it. I don't take a view on Brexit per se because I'm a public official. But you've asked me in this committee many times on the economic effects of it, and I said in the shorter run, making an economy less open will have a negative effect. In the longer run, obviously the real economy can adjust. And part of that adjustment is trade agreements with other parts of the world, which the previous government was seeking and this government is seeking. There's continuity there. The India trade agreement, has been in the works for a very long time, hasn't it? So it's good to see it. It's really good to see it materialising. The effects of those agreements, they tend to take quite a while to come through. I mean, it requires sort of adjustments going on in trade patterns, in real economy patterns. So in the long run, that's what we need to see in a way, because it will help to help the economy to adjust. It will support the development of markets, but it will take some while to come through.
So previously, the banks estimated that the Trade and Cooperation Agreement reduced UK productivity by 3.25% compared to EU membership. At what point will you be able to estimate how the new agreements compare to that?
We'll need to know a lot more about how they go and that they take effect and what economic impact there is from them. And of course, the EU agreement is quite a specific thing. It's not a trade agreement in a broad sense. It's addressing some particular areas. I genuinely hope that it is obviously it's a path on the trade side towards more things, because I do strongly take the view that I'm afraid if we can rebuild trade with the EU, because they are our largest trading partner, that's a good thing.
Thank you. Dr. Dhingra, I wanted to ask you about the trade agreement, because in your previous hearing and in your questionnaire, you wrote in quite some detail about the complexity of understanding the impact of Brexit, the multi-layered impact, and the timing of Brexit in relation to the pandemic and the Russian war in Ukraine. So could you let us know whether you feel as though the agreement is making that position clearer going forward?
I think so. So just to give a little bit of background, when I was asked in the last hearing, we had just about come out of the Ukraine war, and it was still the latest data we had at that point was 2022. And compared to then to when we did the stocktake and the MPR as well as now, we've got a lot more information, but we're still very limited in terms that there is no granular trade data that is available post-2021. That's a very serious issue, other than the one that you can see on goods exports from the HMRC. So, but I can still summarize for you what we have learned from the aggregate statistics as well as more generally from the granular data that does exist. So the first thing to note is that the Brexit referendum left us in a weaker position. That was largely driven by the sterling depreciation effects, which came through both in terms of prices for intermediates as well as prices of what the consumers have to pay. So that's something which set us back. So we went into the pandemic much weaker than most economies would have been at that point. Then comes the period when the TCA, when we're still deciding what the shape of the new TCA would be. And that was a period of serious uncertainty in the economy, and that shows up in weaker business investment in the country compared to, say, peer countries that we could look at. Now you come to the point when it's post-TCA and the Ukraine war has happened. The biggest challenge was how do you actually tease apart these effects, which are from the Ukraine war, the pandemic, and Brexit. And I think at this point, most of the analysis that's been done has been of the type that can we see what happened in some of the restricted goods exports, what has happened in some of the more restricted services exports. And a lot of our work, sort of more broadly amongst the people who work on international trade in the country, is generally that it hasn't opened up the kinds of new products, the kinds of new markets that that there had been some hope might be what would come out of the TCA as well as more generally other trade agreements. If anything, it set us back quite a bit in terms of openness. And where does that show up? So the numbers out there, and I'm more on the sort of middle of somewhere of these numbers, which is that goods exports have fallen by 13% in one case, if you look at the detailed HMRC data. If you compare with peer countries as well with more updated data from 2023-24, the number's going to start looking much bigger in the order of 25% or so. And if you look at some of the newer work that we're doing on services exports, I think you can really tease apart what the TCA impacts are, because we've actually codified the TCA and where the reservations come in and where the restrictions don't come in. And you do see that the restrictions have led to a reduction in services exports, even though we're such a services superpower and there's been a worldwide services export boom, we've lost market share. And I think those are the things which, when you talk about these trade deals, I think this is where they really can make a difference, that a lot of it is about trade costs that will come into being some point in the future. And if we can try and stem that tide, that is where productivity starts to go up.
And have you, at this point, been able to estimate the extent to which the agreement from last month has stemmed that tide?
Not quite, because I think it's far too early to talk about that. If you look at the basic numbers that say the HMT or the Department for Business and Trade have given out, there's somewhere in the range of about, you would add about a little less than 0.5% of GDP forever on in about 10 years' time. So these are fairly long periods. So it doesn't, that being said, I should mention, unfortunately, trade models do give you very small numbers, and we tend to think that these gains are actually much larger than that.
Devastating cut through of government spin, Dr.
Ms. Blake. So would it be fair to say that the reduction in productivity estimated from the Trade and Cooperation Agreement has had an impact that is still having an effect on our economy now, and that the recovery, and that to characterise it as such, will take longer than perhaps the initial impact?
I think so. I think we can say that we went in looking weaker, and when we've come out of the pandemic, we haven't recovered as fast as many of the other economies. That's not to say that we didn't have a much bigger energy supply shock than most other countries, but I think still there is a contribution that is coming from the fact that we're a less open economy, and we've always been excellent at being an open economy.
Thank you. I wanted to ask Ms. Breedon about how the impact of the UK-EU arrangements have perhaps affected our stability in relation to the US tariffs.
Just so I can check your question, Ms. Blake, it's to understand how the developments in the UK and Europe affect our relationship with the US.
Yes.
I'm not sure I've got a terribly good answer to that question, if I'm honest, Ms. Blake. What I would describe it as is that the Europeans and the UK are facing similar challenges in their dialogues in pulling a trade deal together with the US. Obviously, the UK has been able to pull one together more quickly. It was the first one that the US signed. Perhaps that has obviously been supported by being not a member of the European Union.
And thank you. Dr. Mann, I wanted to ask your assessment of the UK-EU trade arrangements now and the impact that they might have on our stability compared to our previous relationship in relation to the US tariffs.
So there are a couple of different pieces of that, one regarding financial stability and one regarding sort of a real side effect or inflationary effect coming through the tariffs. So on the tariffs, there's still uncertainty about how the policy will ultimately play out. And so its implications for growth and for inflation are uncertain. I do want to pick up, though, on a point that was part of a discussion earlier on how the path of inflation may be affected in the UK from global developments on tariffs. So there is a view that the tariff, the US-China tariff war and other tariffs that are being implemented on other countries will precipitate overall lower international prices. And in principle, the UK could enjoy those lower international prices. I think of that is the effect that comes at the dock, meaning suppose it comes on a boat, for example, that's at the dock. However, what the prices that a consumer faces or a household faces is on the shop shelf. And there are quite a few additional players, transportation, advertising, inventory, storage, domestic costs between the dock and the shelf. And so even though international prices maybe have a disinflationary impact on the UK, how the domestic aspects of pricing play out is very important for what kind of disinflationary effect we see at the final consumer or household end. My view is that there's less of a disinflationary impact than what we assume in our models that don't really take account of all of the channels from the global prices to the domestic shelf. So that's one aspect that I think needs to be considered. On the financial side, I think that it's still premature to determine the outcomes of the tariffs on global markets. We still see a lot of volatility, and I've already talked somewhat about how that volatility plays into my assessments of appropriate monetary policy.
Thank you very much, Dr. Mann. Thank you, Chair.
Thank you very much, Ms. Blake. Over to Dr. Jeevan Sander.
Thank you, Chair. Dr. Dhingra, I want to speak about the impacts on inflation at the moment. We know that energy prices are leading to a rise in inflation, but particularly how energy prices are impacting core inflation indirectly. Could you set out your views on that?
Sure. So a lot of what I planned to do when I came for my first hearing here was to think about the supply chain, and that's largely where my background is from. And I think what I was probably surprised to find, which I wasn't aware of before I started any of that analysis, was how dependent we are on energy and imports, as well as not just directly, but indirectly. So to give you a sense of the numbers, 3.5% was the number that was quoted all the time, saying that this is the energy shock. That's how much 3.5% is our consumption basket that is reliant on energy. Once you add in the fact that we're buying domestic bread and that bread itself has energy contained within it, you start to look at a number which is in the range of 8.5%. If you compare it with the euro area, that number is about 5%. So we're talking about much greater exposure. Now, once you start adding in imports into the mix, so not just energy, but also other imports that we buy from abroad, that number is somewhere in the range of 36%. So we're talking about, that number which we usually look at, which is 15%, almost sort of doubles or a little bit more than doubles in this case. So I think that is really where a lot of the impact on inflation still is, even though, so till the last moment when I could do this analysis, which is before the PPI series was stopped, is the end of 2024. And by then, so just to give you some context, in 2022, 11 percentage points of the 17 percentage point rise that had happened between 2019 and 2023 was to do with the energy and import basket. If you then fast forward to the end of 2024, that number is somewhere in the range of 9 out of 24 percentage points of that rise that's happened since 2019 in the aggregate price level. So we're talking about still almost a third of what you're seeing in terms of inflation is really to do with imports and energy still sort of having a role to play. So I think we can't sort of lose sight of the fact that some of these things are fairly sticky, and as they pass through the supply chain, that takes time. Last time Dame Harriet Baldwin asked me about how long that takes. I think roughly in the range of anywhere between when it shows up in terms of firm prices to when it shows up in terms of consumer prices is 1 to 2 quarters, roughly around there.
That's a very, on that clarification question, you spoke about basically imports and goods. Did you also, your analysis include, for example, the impact on services? So I go to a restaurant and there's more energy prices are higher, therefore the sticker price is higher there. That also include that?
Absolutely.
Okay, and then
so that's the entire basket, not just goods.
And then on that, for example, so clearly monetary policy is really about the demand side, but here you're talking about supply shocks that are feeding through into a wider basket of goods. Do you think monetary policy can effectively constrain energy, or rather inflation, if it's being driven by energy prices?
I think that's the big debate, is when do you make that judgment call about when you act against a supply shock, when do you lean against a supply shock? Of course, there's always going to be a much worse trade-off when you're dealing with a supply shock, with a demand management tool. But that being said, I think the times to lean against a supply shock would be the kind that we saw just in 2022, where you see inflation running so high that you cannot but expect that there will be second-round effects which are going to happen through relative prices adjusting, through relative wages adjusting, and which is what a market economy has to do to be able to balance demand and supply. And I think in that sort of setting, it's appropriate to use monetary policy, even though it's much better at handling demand side, to be able to weigh against inflationary pressures that might arise in the future. That being said, I should mention that all of this came with the backdrop that we thought, when I came in, I thought inflation was going to peak at 13%. Those were the numbers we were seeing. But it ended up being 11%, and that was, of course, to do with the energy price cap as well. So it's not as though monetary policy is the only tool that can be used. There is a role for other tools they have a role to play as well.
And now that we're through that period of high inflation, I want to think about some of the things you've said before. So your 2025 Dow lecture, you mentioned how monetary policy could be counterproductive because it constrains investment that will increase supply resilience. So in this case, for example, lower energy price, more accurately, I suppose, our dependence upon energy, the natural gas price movement. At the moment where we are in monetary policy, do you see the same risk as being present, i.e. a higher interest rate that's needed is leading to less investment in the things we need to in order to reduce inflation in the future?
That's definitely one of the key channels through which monetary policy works. We don't have a tool that can distinguish between demand and supply. When we use our tool, it affects demand as well as supply factors. And I think that's really where my difference, say, from the committee's vote decisions have been, that I place a greater weight on some of that supply capacity and the resilience of that supply capacity going forwards, that I don't want that being dented too much either.
If you had a say in fiscal policy, would you be encouraging the government to do more on that side, to invest more in, if you like, resilience to these shocks that can have second-round effects that lead to higher inflation in the future, etc.?
I think that's the biggest lesson we should take from this cost of living crisis, that when you have supply shocks of this virility, you have to have other supply chain, systemic supply chain risks that you've got to take into account and have those tools and deploy those tools. A lot of governments do that everywhere in the world.
Thank you, Dr. Dhingra. And to you, Dr. Mann, as well, I suppose the same question, given your history of the MPC, do you think there should be a greater role for fiscal policy in reducing future price movements and price shocks?
So I'd like to come in on an earlier point that you asked about, which was the importance of monetary policy, the restrictiveness of monetary policy and its implications for business investment and therefore for the supply side. I do a fair amount of work on business investment with the Productivity Institute. And what we have found in the research is that the monetary policy's role in the cost of capital, which is the variable to which business investment does respond, is quite limited. In other words, businesses undertake investment decisions relatively more based on what their internal decisions are about a hurdle rate. And the relationship between the hurdle rate, which is based on what managers think, it's based on some history to discipline different parts of the firm if it's a multinational. That hurdle rate and its relationship to the monetary policy setting is very, very limited. So what this means is that the role that monetary policy can play in affecting business investment is much less than what kind of Econ 101 would suggest. Doesn't mean it has zero effect, doesn't mean it has limited effect. And in the UK, probably the more important channel is monetary policy affecting consumer demand through the channel of cash flow effect on mortgages. And so the demand effect for driving business investment is much stronger. It's one reason why the TCA, Brexit, that we've already discussed, the one reason why sluggish global demand as a consequence of the current set of trade policies, that these sources of slowdowns in demand, as well as the uncertainty about demand, are far more important in driving the current state of business investment than is monetary policy. So all that with a background, thinking about strategies to enhance business investment, the role that a fiscal policy can play in creating a catalytic environment, which is supportive of business investment, that could play, in a standard Keynesian sense, could play a very important role.
Thank you very much, Dr. Mann. Thank you, Chair.
Thank you very much, Dr. Sander. Lola McAvoy, MP.
Thank you, Chair. So thank you to the panel so far. It's been fascinating. I am an optimist, and given what we've heard about the increase in the US risk rating, which poses, I would argue, an opportunity for the UK economy, and the warm welcome from businesses about the trade deals in the EU and India, Governor, are you being too pessimistic?
Well, I've welcomed these trade deals, if you don't mind me saying so. I think they're important. Where I am concerned is that the overall picture on trade now, I'm afraid, is one where, I think the phrase that was used at the weekend in one article in the press in response to the speech I made last week is the rules-based system is sort of dead. And what do we mean by that? Well, over a long time we built up a pattern of world trade agreements which led to a lowering of tariffs. It was initially based around, post-war it was based around the GATT, which became the World Trade Organization. And I'm afraid that system has now, really been, blown up to a considerable degree, let's be honest, by all of this. And that has that has very serious consequences for the world economy. And the point I made last week was that I do think I think there are genuine reasons for why this has happened, which we have to be, very focused on. We can't just, as I said last week, say, the US administration is just wrong-headed. I mean, there are things that have gone on in this whole trade picture which I think do point to the stress that system has been under. But if we basically abandon that system and say we're never going to get it back, then that has quite very serious implications for the world economy. I'll give you one example of this, and it's really at the heart of this so-called rules-based system, is what's called most favored nation. Because the principle of most favored nation is that when you do a trade agreement, you give this, you give the same terms to all your other partners. That is now, gone for them. I mean, it just isn't part of the current picture, and that's a very serious implication. So, I don't want to be called a pessimist, because my whole point is, I do think we've got to come back to the multilateral table and say we've got to work very hard to say, okay, we understand there were problems with this system. It wasn't working as it should do, but if we abandon it, then we're into a much more difficult world.
Okay, and
could I come in on this? Just could I come in on this to make a particular point, and that is on the point of most favored nation. When that is eroded, when the companies have to consider, if I do business in this country, I have these rules. If I'm doing business in that country, I have a different set of rules. If I have business in a third country, I have a different set of rules. Any multinational has now 3 sets of rules that they have to embed into their contracts, into their cost structure, and the legal system. And multinationals play a very important role in the UK. They account for 50% of a business investment. They're 0.5% of firms, 50% of business investment. And so making that environment more costly for them to do business is part of the negative outcome of this fragmentation of the trading environment. And it's not, often we think about it in terms of just supply chains. This is beyond supply chains. This could be doing business in exactly the same countries as you did before, but you have 3 different, my example here, you have 3 different cost structures, 3 different legal arrangements, 3 different contractual strategies, and it becomes what my advisor from long ago called a spaghetti bowl, instead of spaghetti bowl of negotiations and arrangements that clearly will add to the cost structure.
Thank you. Thank you. A really clear description.
Thank you.
Ms. McAvoy.
I suppose what I'm interested in is about the framing of the impact of your decision on the 0.25 percentage point and what that means for business and consumer sentiment, which we know drives growth. So the appetite for people to invest in the UK, we want to see as many as possible, obviously, and we want to see people feeling better off. And the wages are going up, we know that. We want to see people spending those wages in their local economies so that we can see everybody feel like things are better in the UK. And I suppose the economy grew 0.7% in the first quarter, second fastest pace since the pandemic. But bank staff estimate that underlying GDP growth is 0. So I suppose I would like to understand a bit more about the difference in those opinions compared to what looks like a good result, I would argue.
Well, obviously, it was a good number, and don't want to take away from that. The challenge we're describing is, to what extent does that describe the underlying pattern? And frankly, we've had more volatile sort of short-run GDP numbers of late. Maybe that's just a reflection of all the shocks we're having to deal with. The challenge we have at the moment is that the forward-looking sort of evidence on activity in the economy, so the surveys, are nothing like as strong as that. So there is a disjoint, if you like, between that number and the pattern we get from the surveys. And the evidence from sort of all the work our staff do to assess the past and what we draw from it is that the surveys are probably on average a better predictor of the future than the immediately previous GDP number. And I should add to that the agents and my own visits around the country are somewhat supporting the survey evidence. So that's why our staff are saying to us, look, it's an encouraging number clearly. There are probably some one-off elements in it, but the pattern that we're getting from particularly the forward-looking surveys is not as strong.
Okay, and so you've got your 12 agents up and down the country in every region.
Yes.
That's not that many. Is it? I mean, one person in every region. From the northeast, I know that.
Well, it's more than one. Hang on, it's more than one.
Okay, so how many of with the surveys and the agents, how much of the business community in the UK is represented?
Well, the surveys, I mean, because there's a whole range of surveys, you know, if you I mean, I've not done this, but if you add them up, and it would require a lot of work to do that because you'd have to pick apart the double counting. I mean, I think all the various surveys get around quite a lot of the economy. We obviously have our own survey, which is the decision maker panel. But there's many surveys beyond that. You've got CBI surveys, you've got purchasing manager surveys, you've got individual, you know, surveys run by particular. I mean, Lloyds Bank run one, for instance. So if you add all those up, I think you're getting a pretty good coverage.
Okay, so I suppose it comes down to the confidence that we've all got in current public data as well, and we've raised this before about the productivity puzzle and the fact that productivity is looking lower than it was in Q1 2024, but 1% higher than Q4 2019, and so that again poses that question that I raise every time about the reliability of the productivity data during the pandemic and how that's impacting policy decisions. And I just wondered if you have confidence in those figures, or do you tend to have to be over-reliant on your own survey and your agents because of the lack of confidence in the data?
Well, I mean, look, there is a puzzle, and there is a puzzle in the last 12 months, because obviously we had very flat growth throughout particularly the second half of last year, that the productivity numbers would tell us that we had negative productivity growth last year. Now, possible to have negative productivity growth, obviously, but it is usually, going back in time, the case that negative productivity growth is associated with quite serious recessions. We didn't have that last year. So there is a puzzle there, that we had negative productivity growth without many of the conditions that are typically associated with it. So yes, that does give us a puzzle over exactly what the picture is, what the data are telling us, and that's why we are consumers of every bit of useful data we can lay our hands on, frankly.
Thank you. That's fine for me.
Thank you very much, Ms McAvoy. UN Young MP.
Governor, I'm going to return to our favourite multi-part drama of the labour force survey.
About data.
What happened since your Mansion House speech on this?
And we were told by the outgoing national statistician that the improvements to the labour force survey should have fed through by May of this year. Do you feel they have fed through?
I think, with due respect, it's work in progress. And look, I don't want to take away from the fact that I think the ONS are working very hard at this. So I don't want to take this. I think what they've managed to achieve so far is that they have expanded the sample, or the scope of the survey, and therefore raised the number of people who participate in it. Though I believe it is still below where it was pre-COVID in that sense. But as the OMS have said themselves, they don't believe, and this is why there's a very severe health warning on every release they make, and it remains there, that until they introduce what they call the new transformed labour force survey, which will not be now until I think next year, we should still regard the labour force survey with a great deal of caution and a big health warning coming on it. So it remains in that situation.
I noted that you'd had bank staff estimating a new model for employment growth, as you detailed in the report. That shows that it's flat compared to, or decreasing possibly compared to the ONS. What I'm curious about is whether the bank and perhaps other agencies are now having to substitute your own staff resource for the lack of clear signal from the ONS.
We are doing more on that. Yes, we are doing more on that front. I mean, we always had other models, because going back to the answer I was giving to Ms McAvoy's question, we always want, the official data isn't forward-looking, so we're always consuming surveys and talking to firms and so on and putting those through models, but we're having to do more of that to compensate for the labour force survey. So, for instance, I mean, we're putting more weight, for instance, on the HMRC data in the area of employment, which obviously does give us a read on employment. We use other surveys, we use our own agents, yes. So we are doing more in that field, yes.
And finally, the Cabinet Office is now making an inquiry into the ONS. I was wondering if the bank is involved in that, and if you have any...
We have, obviously, I know we've spoken to the person leading the inquiry and said, yes, and said, look, we're happy to offer any assistance we can. I think that was quite welcomed. I haven't got, if you would like an update, I can give you, but I mean, obviously, I think the best thing is that goes into the inquiry and comes out at the other end, as it were. but I can certainly let you know what we're doing. But I think it's probably better if we let the inquiry do its work in terms of.
And I think your views have been clearly on the record to us here and in other fora.
Thank you. Can I just ask one on, just following up from Ms. Yang? So on how much does your confidence in the data sets impact your decision on the rate cut?
Oh, it does have a bearing on it, yes.
If you had to pick how heavily weighted towards
So
that?
I think we have certainly, let's take the LFS because it is obviously probably the best example. Our confidence in some aspects of that, and particularly those aspects where it's not so easy to substitute. So inactivity is the real problem area here because Ms. Yang was asking about employment, for instance. It's easier to substitute alternative estimates in for employment and unemployment. It's much harder to do it for inactivity. There's really not much of a substitute for So yes, it does enter in. We have to sort of say, well, are we confident of what the picture is? We certainly spend more time on it, and that's obviously what we should do, given the uncertainty. So yes, it does have a bearing on it. Yeah.
A lot of people's mortgages hinging on them getting the data right, aren't they?
If I may just add one point, I do think that's where the other data sources really come into play. So whilst being unable to rely on the LFS, we do have the data from HMRC about what's happening to employment. And speaking personally, that and the survey data has been a helpful contributor to how I've thought about policy from here.
The HMRC data, how representative of the wider employment market is that? Because obviously you've got self-employed people.
It misses self-employed, as you say.
Thank you very much, Ms. McAvoy. Dame Harriet Baldwin, MP.
Thank you, Chair. After the inflation spike, the court commissioned Dr. Bernanke from the US Federal Reserve to review your forecasting approach. And yes. I know we haven't got the Deputy Governor, Claire Lombardelli, who's implementing that with us today. So I just wondered if I could ask you, yes. Governor, for an update on the progress, both on the infrastructure in terms of the computers that do the modelling, but also the approach that you're taking towards scenarios, yes. because you committed to implement all 12 of those recommendations.
Yeah, so let me run through it quickly. So start with scenarios. We used and set out 2 scenarios in the Monetary Policy Report this time. One was designed to show where we could see things going if the demand story was weaker. Now that could be a product of domestic conditions. So we weren't specific. We weren't saying it's got to be this particular situation. We were doing it more general level, which we think is useful. So in the domestic side, let's say, for instance, that the saving rate doesn't fall. It's currently at a very high level. And therefore we don't get a bounce back in consumption of that sort, but we could obviously apply that demand story into the international environment as well. Let's say we get weaker demand as a result of the trade issues. The other one was the opposite side, if you like. It was a supply story, so it was producing the opposite effects. And again, we could tell that story domestically. We could tell that story about the labour market, for instance, and the supply of labour, or we could tell it internationally, as we were discussing earlier about supply chains. And so we set those 2 scenarios out. We set out a view on what we thought were the inflation and the inflation implications of them, and the implications for the output gap as well. Speaking personally, I found them very helpful in terms of, in a sense, framing my decision. I think it goes back to an earlier question, actually, in the sense of, well, if I'm wrong on this, but wrong with implausible sort of ranges, sort of what could be the consequences of that? Is it sort of an acceptable thing that we would deal with or not? So that's where, and we will go on developing those, by the way, and scenarios. We've introduced a number of new models. We've also re-estimated the core model. We've introduced a number of new models, and the staff are working on further models as well. So our model suite, we've always had a model suite, but our model suite is expanding. You mentioned the data platform, which is the big piece of work in a sense in terms of the amount of effort going into it. That's well underway now. It's a big piece of work. And we're also using this opportunity to look at much broader data questions, including AI, obviously, is how we use that.
So would you say that the recommendations have been half implemented, 3/4 implemented? How far would you characterise it?
I'm not going to put a particular
number on it. You wouldn't say they were fully implemented?
They're not fully implemented yet, because we haven't finished the data platform, certainly. but they are now substantially underway, and we're able to use some of the results of them. The forecast process, again, the data work has quite a way to go, but it is, we've already achieved things which are helping the team in terms of doing the forecast process.
Ms. Breedon, was that you putting your hand up?
Yes, I had a couple of things that I wanted to share on that, Dame Harriet. I think one big innovation that you can see in the scenarios that we published this time was that we're not just putting different shocks through our models, we're thinking and able to quantify how might the economy be operating in a different manner. That, I think, is a real step forward in our ability to use scenario analysis. And then the second thing that I wanted to say, and this is speaking personally, I think having scenarios has led to us having different debates as a policy-making committee. We're able to quantify the differences, track them through time, understand, as the governor was saying, how wrong might we be. So in addition to having the scenarios, I do think they're driving better policy outcomes.
Thank you. And Dr. Dhingra, in your questionnaire response, you speak about the scenarios. And I also noticed that the IMF, in their Article 4 summary on the UK economy that was published recently, they were talking about encouraging the bank to move away from market pricing or using what the market is pricing in and to focus much more on the scenarios. Do you see that as being the same thing, or how do you feel about this approach?
I think where that would be helpful would be that it's not very useful to know what the number is for GDP growth, but to understand what is the underlying factor driving that number. And a lot of the scenario analysis, sort of playing around a lot with what kind of rate paths you should underpin, helps us understand that. And just to reiterate the point that Deputy Governor Breedon raised, I think where the scenario and all of these changes have helped is that the quality of the debate is improving. Okay. So we can actually have a discussion which is much more focused, and we can also challenge each other's views in a much more quantitative way. And I think once the data platform is underway, and when staff are able to use that in an easy to use way, then we will be able to have much more meaningful discussion.
Is there a date for that data platform to go live, Governor?
Oh, fully it won't be until certainly next year, but this is because it's a very big piece of work, and we're looking
beginning of next year, end of next year?
No, well, certainly not before the middle of next year, I would think. But as I said, because we are looking to be pretty ambitious here, and for instance, I think things like AI factor into it, we're sort of giving ourselves quite a lot. I mean, this is a we want to do something big at this point.
Okay. Dr. Mann, did you want to add anything on this question about the implementation of the Bernanke review recommendations?
So the part about when you were asking about the models, one of the major models that is used, the general equilibrium model, was already underway to be re-estimated, but it importantly has been re-estimated in a way that allows in the scenarios, and I'm going to repeat what Deputy Secretary Breedon said, but I'm going to use different language, and that is our discussions over the past couple of years have often surrounded what is the elasticity, or how strong is the relationship between, say, unemployment and wages. It's a very important relationship in economic analysis. And is it a low elasticity? Is it a strong elasticity, a high elasticity? And one of the things that the re-estimation of the major model compass allows us to do is to vary that parameter. So when we would used to have a discussion, and this gets back to what Dr. Dhingra was saying, when we used to have a discussion of, oh, I think that the relationship between wages and the labor market is not very strong, a flat Phillips curve, so to speak, or it's very tight, we were just talking through words. Because the model now allows us to physically go in there, or staff, of course, do this, physically go in and change that parameter, and we can see what the impact would be of my story versus your story on the slope of a key relationship that underlies inflation, this is part of the reason why we can have much more constructive debates about prospects for the underpinnings for the inflationary pressure or the wage pressure and inflationary pressure, which then, obviously immediately feeds into the monetary policy decision. So to me, this reestimation also marries some of the partial equilibrium research that's done and has been part of, in particular, my decision making over the last couple of years, and the macroeconomic model. And having that marriage between micro and macro is something that, in my view, strengthens the underpinnings of the decision-making process.
Come back on the, I just want to come back on the interest rate path point you make, because it's a very interesting one and it's an important one. We do have a challenge here, because obviously the market curve is, I mean, all these curves are conditional, obviously, on certain assumptions about the future. And I'm very sort of sensitive to having loads of experience in this field, that everything we say that's conditional gets translated to be unconditional. Obviously, with the scenarios, you can't use the market curve, because the market curve is conditioned on a view of the world that is too far away from the scenario. And particularly if we publish interest rate price, which I'm sure everybody would love us to do, obviously, and we will, in a sense, that's where we should end up if we can do it sort of sensibly. So we've got an issue there, which we will work our way through. One option would be to use so-called policy rules, which I think there's sort of greater understanding with some policy rules, at least, that because for the last 25 years, and we and other central banks are saying we don't actually use them to set policy, we use them as illustrative guides. Because I'm very conscious that if we stick down an interest rate path, people will say, oh, so that's what you're going to do, is it? And we're not saying that. We're saying conditioned on this particular view of the world. That's a sort of sensible interest rate path to attach, which allows you then to draw out the conclusions for inflation and activity and so on. So that's an issue still to be.
Thank you. Just before we move on, you mentioned AI, Governor. We were looking at AI in
Yes.
financial services more generally. What risks do you think there are, and what parameters are you putting around the use of AI in the scenario planning?
Well, if you start at a more general level, and Sarah may want to come in because she does a lot of work in this field across all our interests, I think you face a number of challenges. So we want to use AI because, of course, it's actually going to improve our productivity in important ways. So areas like coding, for instance, I mean, it's already, I think, demonstrated it can do that. The challenge, I think there are two challenges we have in this area with AI. Well, one's general, which is that AI is far more of what I call a black box than classic sort of models. And our approach, and to sort of flip over to our approach as a regulator, for instance, when banks use them, has always been to say, we want you to demonstrate to us that you understand how the box works. Now, the problem with AI, if you start using things like LLMs, is that actually you can't apply the same test. None of us know how those things work and can know how those things work in the same way. So I think we're all feeling around for how do we get ourselves into a world where we sort of balance the benefits of doing it with the issues that it presents.
We had some quite trenchant evidence from banks saying it's fine, we deal with that other risks, and we have ways of doing this, and it's all working jolly well.
I'm very pleased to hear that.
That's what they were saying. So, yes. But you sound a bit more cautious.
Well,
what
I
are you
would
putting
say
in place
if you've got some of the people in the room who are genuine world experts on this subject, they would give you slightly different views, obviously, but they would not be that confident, frankly, on that question. So, there is a real set of issues there in any use of that system. The second thing I think, and we've already seen a bit. Our staff have tried to do economic modelling and do economic modelling with AI. And one of the challenges with AI is that I'll try and be sort of not too technical now. It's basically a one-step ahead model. So it says, give me a vast amount, suck everything in that I can find. I'll do all the sort of, assessment of what influences things, and then I'll tell you what the next step is, and then it can step onwards. The problem, and Katherine was making this point a few minutes ago, is that a lot of the modelling we do is actually what I call structural. Katherine made the point, we want to understand the relationship between, wages and unemployment. And to do that, you need a more sort of, we typically have a more structural view of the world. So when we did one of the scenarios, how we actually implemented it in the modelling world was to sort of change the slope on the so-called Phillips curve, which exactly goes to what Catherine's just saying about the relationship, changing that relationship. AI models don't really do that, so they're not as stable in a sort of structural sense. So they're interesting, but they tend to be so far less stable. But look, the world will move on. I mean, one thing we know, these issues will move on, and new approaches will emerge.
Ms. Breedon, you wanted to add something?
If I might add, Chair, I think the important thing is to be really clear what use cases you're applying it to, how the inherent risks associated with AI manifest in that context, and put guidelines and guardrails around it. So coding, producing charts and presentations, doing back office processes, all of that is very
shortening
different.
my draft speeches.
That's right. Shortening speeches is a great thing. But making sure that the prompt is a good one and it doesn't just stop it at 2,000 words, because you have to add, retaining all of the points that I
We'll be listening very carefully to the Governor's next speech. See how well it's working.
Very good at that, actually.
Thank you. That's very, very interesting. I don't know if any, just briefly on this, if Dr. Mann, you had anything to add on AI from your experience?
I think not really. I think that I think the combination, whenever you're dealing with models, there's both the unstructured models that quote unquote let the data speak, and AI is a particularly granular manifestation of letting the data speak. Structural imposes, economic theory, and then it allows you to look at these different possible relationships and how strong they are. The key is to have both. You don't ever put all your eggs in one basket. Yeah. So you have multiple models. You test them using multiple data sets. And you evaluate what they're telling you. If they're all telling you the same thing, you'll be pretty confident on making the decisions. When they start to tell you very different things, that's when you start to say, okay, are the assumptions underlying the structural model too restrictive, not realistic of what the data actually are telling us? Or if the purely data models are giving you an outcome, it's like you look at it, well, is that just garbage in, garbage out? So looking at the set of them and how they either are similar in guiding your decision, or they are different, and in their differences you understand more about what's going on in the economy. That's the beauty of having a suite of models using different technologies.
Thank you. Ms. Breedon wants to come in again. I just wanted to see if Dr. Dhingra has anything.
So just one thing that the AI has been really useful for, Chair, is summarising all of the intelligence that we get from our many agents round the country, being able to ask, what have companies been telling us about the new packaging regulations and how that has how that has affected their costs, has been a useful thing.
Thank you. Dr. Dhingra, anything to add briefly?
One line. I use AI in my research almost every day, but I would not use it to set monetary policy.
Thank you very much. Very, very helpful. Mr. Chris Coughlin, MP.
Thank you. Dr. Mann, I always assumed that quantitative tightening should be broadly inflationary neutral and fiscally have no impact, because your Bank of England base rate will largely offset the impact. But I've seen some fairly excited op-eds in the FT arguing, in fact, it does have real-world fiscal consequences of billions, because I guess the interest rate differential and you're impacting different parts of the yield curve. Would you agree that it does have a real-world fiscal impact?
So quantitative tightening has been undertaken by a set of different, in different ways by different central banks. And how it impacts the fiscal accounting differs according to that methodology. We also have to think about the overall quantitative easing, quantitative tightening package. And if we think about both of those things, the neutrality of it feeds through. So I do think it's that fiscally neutral. I do think, on the other hand, if we think about monetary policy implications, I gave us a speech. There's a speech that I gave, which is why I'm in the United States, actually, right now, is at the Federal Reserve, um, indicating that from a monetary policy perspective, quantitative tightening has to be considered along with bank rate decisions, as of course we do that. It works in the background, but we make a new decision for 2026 coming up in September, that the package of implications of quantitative tightening for the long end of the curve, because that's what we're doing, that's what we're selling, and bank rate for the short end of the curve, that we need to consider both of those as a package, again, against a backdrop of the comment that I made earlier of foreign spillovers also affecting the overall yield curve. So it's a complex decision, but these two elements have to be incorporated, bank rate as well as QT.
Yeah, and Governor, what's your view?
Well, on that point, I agree with Katherine, and that's really why we review it. I mean, it's one of the reasons we review it every year, and we're about to embark on the annual process now, actually, because how it feeds through along the yield curve is important. I think Sarah was saying earlier, the long end of the yield curve is less important for the monetary transmission mechanism than the sort of the bit nearer to the short end, but we have to look at the whole thing. We have a team that spends all its time working on the transmission mechanism, and this will get fed through into the review. So I agree with Katherine. I mean, these are things we always have to look at. We've had quite a lot of curve movement obviously going on, and I think what we will have to do is not only, I don't think the cause of that curve movement is quantitative tightening in its own right, but of course how it interacts with the other causes, i.e., what's coming out of the US, for instance, will be something we will have to go over in the next month or two. Yes.
To be clear, do you agree that quantitative tightening is in fact fiscally neutral, and that has no fiscal impact, or if it does, it's purely an accounting thing rather than an actual?
Well, yes, that's a really good point, question. I'll just say a bit on this because there's been a lot of estimates and commentary around on this. Now, let me preface what I'm about to say with a very important point, which of course is we didn't do QE and we don't do quantitative tightening for fiscal reasons. And so if you ask us what the cost-benefit analysis of all this is, of course we would put it into terms, economic terms, into the macroeconomy. But obviously it has an impact. I mean, it has an impact on fiscal policy through the cost of debt. Yeah. And the point I want to make this, because I think many of the calculations, and the FT's had some recently, only tell part of the story in that respect. So I'll comment on it through that lens, which is not our normal lens, but I think it's important to do. And the starting point is that the UK is different from many countries in that it issues public, or has issued public debt with a longer term than others. So I think the average maturity of the UK gilt stock at the moment is about 14 years. When you look at the other major economies, it's about 6. So that's a big difference. Now, the reason this is important is the following. We obviously had a long period when interest rates were near zero, and QE was having the effect of flattening the yield curve out along the tenor. And that has benefited, obviously, the cost of debt servicing, and will continue to benefit the cost of debt servicing for a lot of years to come, a long time to come. So I think I'm right in saying that the current average cost in terms of average coupons on our gilt stock that's weighted average, by the way, is around about 2.7%. So it's well below, obviously, bank rate. And that's an inherited fact that the UK has issued a lot of long-term debt in a period when interest rates were very low. Now, if you say to me, well, okay, but you've actually taken a load of QE and you've transformed that into debt that carries, obviously, the bank rate as its cost. What's that 2.7%? And the answer is it's a bit under 3.2. So it's still well below bank rate. Now, here I get to the final point, is the point that's most relevant to the estimates that get published. Right from the start of QE, we said we want to be market neutral in what we do. We don't want to start skewing the market. So we bought and we've bought throughout in the QE period, equal buckets of short, medium and long. What that means is we've got a lot more long stuff than the Fed has got, for instance, or the ECB's got, because of the debt stock. And yes, it is more costly to sell that stuff off once the curve goes up. And that's what you get reflected in these costs of QE/QT numbers. The point I would make is that those numbers do not take into consideration the benefit that the UK has got from that lower cost of debt servicing as a result of the fact that there is more long-term debt that was issued at the point when interest rates are low. So you can think about QE/QT and the debt servicing cost world as, yes, you give up some of that benefit by us having to do QE and then having to do QT, but you've still got an offsetting benefit there which doesn't get brought into these calculations. So, I would challenge those numbers and say you actually haven't got to the end of the calculation.
And to be clear, I guess to do QE from a credibility standpoint, you've got to say you're going to do QT. I would imagine, otherwise you're a bit like the Weimar
Well, particularly when you've got a long-term debt stock, otherwise
Yeah.
you're going to have this stuff on your balance sheet for a very long time.
Given where we are now, why not just abandon QT, or would that be devastating from a credibility point of view over the long
I
run?
would make there is that, I think we've said this before, but it's an important point that, of course, if you don't sell, then the cost comes through in what we call the cost to carry. So that's the interest rate that you're paying throughout the life of this stuff, relative to bank rate. Now, in efficient markets, those two numbers should be the same. So the cost of selling versus the cost of carrying should equalise. You can argue whether markets are always perfectly efficient, but that's broadly a working assumption. The final point I'll make on that, because again, I think there's a bit more commentary, and I think I included it in the letter I sent to you back in April, I think. And I will only go this far because it's really for the government then. There is a difference between selling and carrying in how they feed through into the fiscal rules. And particularly because one fiscal rule is the at any given time, obviously one of those two rules has to be the biting rule, as it were. And as I think there was an article this morning saying this, curiously, though I'm not advocating this, just to be very clear, from the point of view of that fiscal rule, actually the argument would be we'll do more QT because actually it's the cost of carry that binds rather than sale. Now, that, of course, going back to where I started, that does not motivate us one bit, I should say, obviously, because we're not doing it for those reasons, but that's one of the sort of curiosities of the situation.
Harriet.
Yeah, further to those questions on quantitative tightening, just interested in the latest analysis that you've done, because we've had this discussion before that obviously quantitative tightening, as it says on the tin, is having a tightening impact. I mean,
yes.
That is right in its title. And I think you've previously estimated that it's about 0.25%. Is that still a good number for us to
actually,
assume?
can we wait? So our staff are busy at work on preparing us for the annual review, when we will go through all of this again. It sort of goes to what Katherine was saying earlier. So happy to come back on that question, but I think it'd be better if we did it after we've had the staff material rather than before.
And will the staff material also cover, because you touched on it just now in your answers to Mr. Coughlin, that we've got the glide path is downward in terms of short rates,
yes.
But obviously since last July, 10-year rates are up 40 basis points, 30-year rates are up 70 basis points, and I think you're selling 100 billion maturity. Maturity and some sales.
We're actually not selling much this year.
100 billion this year. So I just wondered if you have done any analysis deconstructing how much of that change in the long-term yield curve is as a result.
Well, that's another part of what the staff will be doing, because
program.
again, I think we've suggested, and I think you can see this certainly from the work our staff do regularly for us for the monetary policy process. Much of the move in UK long rates is caused by the move in long rates elsewhere, of which we've seen US long rates increase, but as I mentioned earlier, we've also seen Japanese rates increase and German rates as well, because Germany's changed its fiscal policy quite dramatically. So at the moment, my view would be that it's the global influences. Yeah. But can I just go back to a point I made a few minutes ago, which is important, that we will have to look at is, of course, you have to then look at the interaction term, as it were, between those effects and QT. So I don't want to we will do that as well, because it's actually important to do that.
And we'll get a chance to see that as a committee.
Yeah.
And can I also thank the Governor, Chair, for the letter that we've published today in terms of the impact of reserves for the banking sector. And you've made that very clear what your views are on that, and
very clear exposition. So thank you. It is helpful to have it. Sometimes these things are better answered in writing. I'm aware that Dr. Mann is in the wee small hours still in the US. So we are. But I did want to just, Dr. Dhingra, just pick on an issue that we've touched on tariffs earlier, but in your questionnaire you talk about. You give scenarios, if tariff impositions and retaliatory actions proceed in an orderly way. And you earlier talked about things being better than not just the worst case scenario, but a bad case scenario. I mean, it seems quite confident. You seem quite confident that things could be in an orderly way. Is that what you're saying? And what does orderly and disorderly look like in your view as a trade specialist?
I think it's easiest to say what disorderly looks like, which is you get a whole bunch of local content requirements coming in. You have supply chains completely distinguishing themselves into regional blocks, and then you basically have to rely on the same supplier to be able to sell here so that we could supply to the US, but then we don't want to supply the same necessarily to China. So those are the issues which would keep me up at night, because then you could get very sharp inflation spikes. That is not the situation we've seen until now. In fact, I would say we've seen something slightly better than what I had hoped for, which is that I would have thought that there would be tariff impositions, and then there would be retaliations from different countries, and then possibly even some anti-dumping duties if necessary. But instead, we're seeing a much more collaborative atmosphere where people are trying to negotiate and avoid these tariff impositions rather than punish them with countermeasures. So I think as long as we stay in that sort of situation, this is something which is going to be a deliberate reconfiguration of supply chains, as opposed to something which comes from nowhere and then we have to deal with it.
You're really basically, in summary, confident that the world is adapting to what President Trump is saying in an orderly way, whatever comes out of the White House.
It comes with the conditional statement there of what President Trump has said up till now.
Okay. Well, we could discuss that at great length, but can I thank you all very much indeed for your time. So that's Dr. Katherine Mann, an external member of the MPC, joining us from the US. Thank you for your coping with the early hour in the US and for joining us. We did want to have you here today, so thank you for that. Dr. Swati Dhingra, another external member of the Monetary Policy Committee, Sarah Breedon, the Deputy Governor, and Andrew Bailey, the Governor. Thank you very much indeed. Order, order.